Imagine it's the spring of 1940. France has fallen. The British Army is trapped at Dunkirk. The world as we know it is ending. You'd think the stock market would be a bloodbath, right? Wrong. It bottomed out, and then, while the world burned, it began one of the most aggressive rallies in history. Fast forward, March 2020, a global pandemic shuts down the planet. Breadlines return, hospitals are overflowing. Yet, within weeks, the S&P 500 hits an all-time high. It feels like a glitch in the simulation. It feels like a slap in the face to everyone struggling on the ground. You're standing in the wreckage of a real economy, looking up at a skyscraper of green candles, and you're asking the only question that matters. Why does the market thrive when the world is falling apart? Tonight, we pull back the curtain on the great disconnect. We aren't talking about buying the dip or simple greed. We're talking about the cold, mechanical reason why the stock market isn't a map of the world. It's a scoreboard for something else entirely.
To understand this, we have to kill one very popular myth. Most people believe the stock market is a barometer for the economy. If people have jobs, the market goes up. If people are hurting, the market goes down. That is a lie. The economy is what happened today. It's your grocery bill, your rent, and your paycheck. The stock market, however, is a massive global prediction machine. It lives 6 to 9 months in the future. It doesn't care that you're unemployed today. It only cares if a company will be more profitable next Christmas. Think of it like a dog on a leash. The economy is the person walking. The stock market is the dog. The dog is constantly darting ahead, sniffing at things that haven't happened yet. Sometimes the dog trips over its own feet, but it's rarely walking right next to the owner. But there's a darker reason for the disconnect, a reason that involves the only group of people who can print $1 trillion before lunch. When the world starts falling apart, the check engine light flickers on at the Federal Reserve, and their solution is always the same: flood the zone. In a crisis, the government doesn't just hope things get better. They lower interest rates to zero. They pump billions, sometimes trillions, into the financial system. They call it liquidity. You can call it a giant safety net woven out of thin air. Here's the uncomfortable math. When interest rates hit zero, your savings account becomes a graveyard for your money. You can't buy bonds because they pay nothing. So where does all that newly printed money go? It has nowhere else to run. It pours into the stock market, not because the companies are doing better, but because the money itself is becoming worth less. It's a phenomenon called the Tina effect. There is no alternative. The world is falling apart, yes, but for the giant institutions, the hedge funds, and the algorithms, a dying world with 0% interest rates is a world where stocks are the only game in town. The market isn't going up because of prosperity. It's going up because of desperation. Let's look at the players in this game. During a crisis, big companies actually have a hidden advantage over you. Think about a massive tech giant versus your local coffee shop. When the world shuts down, the coffee shop dies. It has no scale. It has no lobbyist. It has no access to the bond market. But the tech giant? They have billions in cash. They can fire 10,000 people with a single email to optimize their margins. In a strange, twisted way, a crisis is a gift to the biggest corporations. It kills their smaller competitors. It allows them to lean out their workforce. So while the economy, meaning your neighborhood, is suffering, the market, meaning the top 500 companies, is actually becoming more dominant. The market isn't cheering for the tragedy. It's cheering for the consolidation of power that follows it. But here is where the tension sits.
This disconnect creates a wealth effect that is increasingly fragile. When the market stays high while the world suffers, it creates a psychological hallucination. It makes the people at the top feel like the crisis isn't real. It justifies more risk. It builds a tower of debt and speculation on top of a foundation that is actively rotting. We saw this in 1929. We saw it in 2008. We saw it in 2021. The system has learned how to decouple the scoreboard from the game. But you can only ignore the gravity of the real world for so long. Eventually, the person walking the dog has to sit down, and when the owner stops, the dog gets yanked back by the neck, hard. We like to think of the stock market as a sign of health. A green day feels like a victory for us. But as we've seen, the market can be a vulture. It feeds on the restructuring of society. It feeds on the cheap money meant to save us. And it treats your worst day as a temporary headwind already priced into next quarter's earnings. So, the next time you see the Dow Jones hitting a record high while the news is filled with smoke and sirens, don't be confused. The market isn't broken. It's working exactly as designed. It's just that you were never the one it was designed for. The most dangerous lie in finance is that the numbers on your screen represent the world outside your window. And in a world that is falling apart, the biggest winner is usually the one who owns the scoreboard. The question isn't why the market is going up. The question is, what happens to us when it finally decides to come back down to earth?